Alaikum, dear students. I hope that all of you are well with your family members. I expect that all of you already looked at my class. Today, my class is on theory of capital structure. The topic is traditional approach. In the last two class, I have already completed two approaches. One of is net income approach and second one is net operating income approach. The two approach already done. Today I will discuss the traditional approach. I think net income approach and net operating income approach stands in extreme forms. Both of these are stand in extreme forms. But traditional approach stands on the midway of the two methods. Between the two methods. One is to approach, one is net income NI approach, and second one is NOI approach. I think all of you are already realized that what I want to say, that the traditional approach is the compromising approach of between the two approach. One is NI approach and second one is NOI approach. So we know that if the debt or leverage increase but cost of equity capital don't increase, or in this traditional method, but after a level increasing the debt, then increase the cost of equity capital. Okay, we know that there are several approach. In this math, theory of capital structure, we already seen the three methods. One is net income approach, net operating income approach, and traditional approach, and fourth is Modigliani and Miller approach. So we discuss the traditional approach. Okay, it is the midway of two approach, which is already discussed. Okay, so every approaches has some assumptions, or the traditional approach depends on some assumptions. The assumptions are, one, there are two sources. One is common stock and another is debt. Two, debt or debenture. %100 payout ratio. there is no retained earnings. Third is always KE, firm's KE is greater than KD. Four is no tax is imposed on company's income. Five, firms EBIT or net operating income or X bar is unchanged. Six, total amount of capital structure is fixed. Seven, business risk capital structure and financial risk are exclusively independent. Okay, dear students, I think here I see that there is assumptions, assumptions of traditional approach. Okay, although there is seven assumptions, but the traditional approach has some restrictions or has some criticisms. Okay, let's see what are the criticisms of traditional approach. Okay, dear student, let's see what are the restrictions or what are the criticisms. One is traditional approach is very much conditional. Traditional approach is very much conditional. It depends on various assumptions. Okay, so there is no specific measurement. There is no specific measurement of changes of K with the increase of leverage. Three, the risk of all, it is assumed that the risk of all investors are equal, but in realistic it is not found. I mean, the risk of all investors are not equal. Okay, then for there is no tax imposed on income, but it is also unrealistic. But it is also unrealistic. Okay, dear students, I think all of these are criticisms of traditional approach. So, at present, I want to solve a problem, and we should bring out the optimum capital structure of traditional approach. So, we want to bring out the optimum capital structure according to the traditional approach or traditional method. So, here some data are given. I think first one is debt, then second one is KD, third one is K, cost of equity. Okay, so I think it is option 1. I mean debt 0%. When debt is 0%, then KD is 5%. Then K is 12%. Okay, in the option 2, debt is 10%, and there is no change in KD. I mean it is 5%. Okay, here 12.5%. Okay, 12.1%. Then in 3, 30% debt, then 5.5% KD, then K is 13%. In 4, okay, in 4, 60% debt, then KD is 7%, then K is 20%. So the information are given here, so we should calculate this information and we should bring out from this information, we should bring out the optimum capital structure. We should bring out the optimum capital structure. Okay, so the students, we already know that KO, overall cost of capital, KO equal KE into S divided B plus KD into D divided B. Okay, we assume that here total, total equity, total value of the firm is 1. We here assume that we should assume that total value of the firm is 1, and then because here two financing firms, two sources, okay, one is common stock and second one is debt. So when debt is 0%, when debt is 0%, on that time equity financed is 1 taka. When debt is 100%, when debt is 10%, that equity financed on this company, limited company, equity financed is 90%. When debt is 30%, then equity financed, as equity financed is 70%. When debt is 60%, on that time equity finance is 40%. So we should think that debt and equity equal 1 or 100%. Debt or equity equal 1 or 100%. Okay, so dear students, we should reveal uh, here all of these, 4 things. One, number option is so KE, here KE. At first I write down the clue again. KO equal KE into S divided V plus KD into D divided B. Okay, so the students, in one here KE is 12%, 0.12. Okay, so S is 100% or 1 divided value is 1. Okay, 100% or 1 plus KD is 0.05, and here debt is 0%, 0 divided 1. Okay, so 0.12. Okay, second one is in option number second. So KE is 0.121 into S shares, value of the shares, 0.90 divided 1 plus KD 0.05 into D 0.1 divided 1 equal. Okay, here 0.121 into 0.9 here is 0.1089 plus 0.05 into 0.1 divided 1. Okay, so here is 0.1, 0.0, 0.05, 0.005 equal 0.1139. Okay. Third one is KE 0.13 into S, I mean 0.70 divided 1 plus KD 0.55, 0.055 into 0.3 divided 1. So here 0.7, 0.13 equal 0.091, 0.091 plus 0.0165 equal 0.1075. Then fourth one is KE 20%, 0.2 into 0.41 plus KD 0.07 into KD 0.6 divided 1, 0.6 divided 1. So 0.4, it is 0.08 plus it is 0.042 equal 0.08 plus 0.042 equal 0.122, 0.122. So in the option number 3, the optimum capital structure is option number 3. Capital structure is 10.75%, because overall cost of capital in the among the four option, overall cost of capital 10.75% is the lowest. Overall is the lowest. So the option number 3 is the optimum capital structure. So dear students, I think that all of you already realized this, and next class I will take a maths on this pattern. Thanks.